Inflation erodes the purchasing power of money, which makes it a challenge for investors to preserve and grow wealth over the long term. To outpace inflation, it's crucial to invest in assets that have historically delivered returns that exceed the rate of inflation. While no investment is entirely risk-free, certain asset classes have consistently outperformed inflation, providing a hedge against the rising cost of living. This video explores the top 10 assets that have beaten inflation over time and can help secure financial growth in an inflationary environment. 1. Stocks, equities. Stocks, particularly those in large, well-established companies, have historically been one of the most effective ways to outpace inflation. Equities generally offer higher long-term returns than other asset classes, despite their short-term volatility. Why stocks tend to outperform inflation over the long term? Because companies can raise prices during inflationary periods, passing on the costs to consumers. Additionally, companies often increase earnings as they grow, providing shareholders with dividends and capital appreciation. Over time, stock markets, such as the S&P 500, have delivered average annual returns that consistently outpace inflation. 2. Real estate. Real estate is a tangible asset that often acts as a good hedge against inflation. As inflation increases, so do property values and rental income. This makes real estate a popular choice for long-term wealth preservation and growth. Why real estate? Real estate appreciates over time and offers the additional benefit of generating passive income through rental properties. Real estate investments, particularly in areas with growing populations or limited supply, tend to see long-term growth that outpaces inflation. Real estate also provides investors with tax advantages, such as depreciation and deductions on mortgage interest. 3. Precious metals, gold and silver. Gold and silver have been long-standing stores of value and are often seen as safe haven investments during times of inflation and economic uncertainty. They are tangible assets that retain intrinsic value, unlike currencies that can be printed and devalued. Why precious metal? Gold, in particular, has outperformed inflation over centuries, as its value tends to rise when the purchasing power of currency declines. Silver follows a similar trend. During periods of high inflation, the demand for precious metals increases, driving up prices. These metals are also often seen as a store of value in times of economic distress, further boosting their appeal. 4. TIPS, Treasury inflation-protected securities. TIPS are government bonds that are designed specifically to protect against inflation. The principal value of TIPS rises with inflation, as measured by the Consumer Price Index, CPI, making them an ideal asset to keep pace with rising prices. Why? TIPS offer a fixed interest rate, but their principal value adjusts based on inflation. As inflation rises, the interest payments increase because they are calculated based on the adjusted principal value. This makes TIPS a reliable, low-risk asset for investors seeking to protect their portfolios from inflation. 5. Commodities. Commodities like oil, agricultural products, and industrial metals tend to rise in price during periods of inflation due to increased demand and higher costs of production. Investing in commodities can help investors preserve wealth when inflation accelerates. Why commodities? Commodities are essential goods with intrinsic value, and their prices typically rise when inflation occurs, as the costs to produce and transport these goods increase. Investors can gain exposure to commodities through ETFs, mutual funds, or commodity futures. Since the prices of commodities are driven by supply and demand factors, they are often seen as a good inflation hedge. 6. Cryptocurrency, Bitcoin. Cryptocurrencies, particularly Bitcoin, have emerged as a popular hedge against inflation in recent years. Bitcoin is often likened to digital gold due to its limited supply and decentralized nature, which makes it resistant to inflationary pressures caused by central bank policies. Why cryptocurrency? Bitcoin has gained attention as an alternative store of value, particularly in times of high inflation. Its fixed supply of 21 million coins and its decentralized network make it resistant to manipulation or devaluation by central banks. Over time, Bitcoin has shown impressive growth, with many investors viewing it as a long-term hedge against inflation. 7. Dividend stocks. Dividend-paying stocks are an excellent choice for those looking for income in addition to capital appreciation. Dividend stocks, particularly those from well-established companies, can provide a steady stream of income that can help offset the effects of inflation. Why dividend stocks? Dividend-paying companies often have a strong track record of profitability, and they tend to increase their dividends over time, even during periods of inflation. This regular income stream can help investors maintain purchasing power, and the price of the stocks themselves typically increases along with inflation, providing both income and capital growth. 8. Collectibles, art, antiques, wine, etc. Rare collectibles, such as fine art, vintage wine, and antiques, have historically appreciated in value over time. While these assets are less liquid than stocks or bonds, they can offer strong returns and act as a hedge against inflation. Why collectibles? The value of collectibles often rises due to their rarity and demand. During periods of inflation, wealthy individuals may seek to preserve their wealth in tangible assets, driving up the price of high-demand collectibles. Additionally, many collectibles, such as art, often become more valuable as they age and become scarcer, providing inflation-adjusted returns over time. 9. Corporate bonds. Corporate bonds, especially those issued by strong, financially stable companies, can outperform inflation by providing regular interest payments. Bonds tend to be more stable than stocks, and those from well-rated corporations can offer attractive yields that keep pace with inflation. Why corporate bonds? Corporate bonds typically offer higher returns than government bonds, and the interest payments can be a valuable source of income in an inflationary environment. The principal value of corporate bonds is fixed, but the yield can help offset inflation. Strong companies with consistent revenue growth can maintain their ability to service debt even during inflationary periods. 10. Foreign real estate. Investing in real estate outside of the U.S. can provide a hedge against domestic inflation, especially in countries where inflation rates are lower or the real estate market is growing at a faster rate. Real estate in foreign markets can also offer diversification for investors looking to spread risk. Why foreign real estate? In many emerging markets, real estate prices are growing faster than in developed markets. Investors can take advantage of these growth opportunities while also diversifying their portfolios geographically. Additionally, foreign real estate markets may be less correlated with domestic inflation, providing a buffer for investors seeking to preserve purchasing power. Inflation can be a major concern for investors looking to preserve and grow their wealth, but investing in the right assets can provide protection and even capitalize on rising prices. Stocks, real estate, precious metals, and tips are some of the most effective assets for outpacing inflation over the long term. Additionally, commodities, cryptocurrencies, dividend stocks, collectibles, corporate bonds, and foreign real estate offer strong potential for inflation-beating returns. By diversifying across these assets, investors can hedge against inflation and maintain their purchasing power in an unpredictable economic environment.